Welcome back to Investing with Mackie. In this series, I'm going to cover the basics of option trading. By the end, you will understand key terminology and be able to intelligently implement basic strategies. In part 1, we will focus on theory and definitions. In part 2, we will look at the practical side with actual options, including option chains, basic strategies, and considerations in choosing an option. First off, what exactly is an option? An option is a financial contract that gives you the right but not the obligation to buy or sell an asset at a specified price, known as the strike price, by a certain date, known as the expiration. There are two types of options: call options and put options. A call option gives you the right to buy an asset, while a put option gives you the right to sell an asset. The right is purchased for a premium or the price of the contract. Why are people willing to pay this premium? Two common reasons are hedging of investments to reduce risk and leveraging speculation of future price movements. To understand this further, let's look at how an option premium changes with movement of the underlying stock. A call's premium moves in the same direction as the underlying stock. If the stock goes up, the value of the call option goes up. If the stock goes down, so does the option's value. Puts move the opposite of the underlying. If the stock goes down, then the put will increase in value, but the put will decrease in value if the stock goes up. The amount of change in the value of the option is tied to delta, which is part of an option's details known as the Greeks. Depending on the delta for each contract, the premium change can vary. We'll briefly hit on this concept in part 2. To better understand this, let's think of an option as a coupon to buy or sell a physical object. Let's say you're watching prices of a new mountain bike. It is regularly priced at $500. The store offers a coupon that allows you to lock in the bike's price for a year for only $10. You can't afford the full price of the bike right now, but are expecting one of your investments to play out in the next year that will easily be worth $500. So you buy yourself the coupon, knowing that with inflation, supply chain issues, etc., you speculate the price of the bike might go up. At this point, your coupon is equal to the price of the actual bike and could be considered in the money. Now, in the future, say future 1, you were right, and it turns out the price of the bike did go up. How much is your coupon worth? Since your coupon allows you to buy the bike for $500 and the bike now costs $550, the coupon is at least worth $50. Maybe the coupon is still good for half a year, and you could sell it on eBay for, say, $55. This coupon is now considered in the money as the cost of the bike is more than the coupon allows you to buy it for. However, another scenario might play out, where a new supplier can get parts for cheaper and the cost of the bike actually drops. Let's say at a point, we will call this future 2, the bike is selling for $450. The coupon is now out of the money, as using the coupon would have you paying more than the bike is worth. How much could you sell the coupon for now? Probably not very much. Maybe you could list it on eBay for $1 or so. To review this example, buying the coupon allows us to use it at your discretion, but you are not obligated to. In the case where the price dropped, we could just buy the bike at the new cheaper retail value. It is also important to note that we are not obligated to use it. If the price of the bike continues to rise to $700 or even $1,000, because we hold the coupon, we can decide if or when we will use it. Also note that as the price of the bike went up, so did the value of the option. As it went down, the coupon value also went down. Let's take a look at a put example. Sticking with our bike example, let's say that the shop owner is getting ready to release a new model. As a promotion, he is offering a coupon that will allow you to sell the current model bike locked in at current used prices. Once again, he charges $10 for this coupon. You know that once the new model is released, the price of the old bike is going to for sure tank. So you buy that coupon. Just as you expected, the new model is released and it tanks the used market, making your bike now worth only $200. Score. You can sell it to the shop for $250. That coupon has increased in value to somewhere around $50 to $55. In this case, it is worth it to use the coupon while the strike is $2.50, which is more than the current price of $200. This scenario puts our coupon in the money. What about if the new model gets delayed and the demand for current models actually goes up? Now you can sell your bike on the used market for $300. Well, that coupon is now kind of worthless and is out of the money. For a put example, once again, remember that as we hold the coupon, we don't have to use it. We aren't forced to use it to sell a bike for $250 when the market's offering $300. Also note that the value of our coupon increased in value when the price of the bike went down, which is different than the previous example. So are these metaphors actually accurate? Yes, these metaphors can nearly mirror exactly how options work. Depending on how you trade options, though, there might be one distinction to make, but it is still valid in the example. Do you have to actually own a bike or intend to buy a bike? And the answer is no. You could buy coupons with the intent to sell those coupons for more depending on how the market goes. Most options are actually not exercised, meaning the owner of the option does not use the option to buy or sell the shares at the strike price. This is especially true for speculative traders. They can simply close the position for a gain or loss without exchanging any shares. While we are on it, opening a position means that you have made a trade that is in your portfolio. You can buy to open or sell to open a position. The same is true for closing. You can both buy and sell to close a position. When determining how much an option is worth, or its premium, we can break it into two parts: its intrinsic value and its extrinsic value. The intrinsic value is the portion of the premium if the option were to be executed right now. When we look back at our bike example, it is the difference between the coupon or strike value and the current market value. When our coupon allowed us to buy the bike for $500 and the actual price was $550, the intrinsic value was $50. The extrinsic value is a little more complicated and is associated a little more with the what if. It is known as the time value of the premium. It takes into account factors like time until expiration, volatility of the underlying stock, and the risk-free interest rate. Essentially, it represents the premium paid for the possibility that the option's value may increase before expiration due to favorable changes in the price of the underlying asset. As the expiration date approaches, the intrinsic value typically decreases, a phenomenon known as time decay. In our bike example, we started off with an at-the-money coupon having no intrinsic value and $10 of extrinsic value. When the price went to $550, we considered selling the coupon on eBay for $55. Because there was less than a full year, maybe we didn't get the full $10 of the initial extrinsic value. However, maybe with price volatility and bike pricing, that could increase that extrinsic value to above 10, depending on what's going on in the bike market. We have covered a lot, but this takes us to the end of part 1. Please put any questions you have below in the comments, and don't forget to drop a like if you found this information useful. And consider hitting the subscribe button to not miss out on any future content.